The American dream is under siege, and the cracks are starting to show in even the mightiest of fortresses. What if the struggles of a corporate giant like Amazon.com are not just an isolated event, but a glaring red flag for the entire U.S. economy, signaling a downturn that could impact your investments, your home, and your future? We're not here to spread baseless fear, but to present you with a series of hard-hitting facts and verifiable data that paint a concerning picture. For years, we've been told a story of unending growth, but the numbers are starting to tell a different tale, one that every savvy investor and homeowner, especially those of you over 45 who have weathered economic storms before, needs to pay very close attention to. The tremors in the market are becoming harder to ignore, and understanding their origin and potential impact is paramount. We'll delve into the performance of Amazon, a bellwether for consumer spending and technological innovation, and connect its recent trends to the broader economic landscape. This isn't just about one company, it's about a pattern of indicators suggesting that the economic engine of the United States might be sputtering, with significant consequences for your financial stability and investment strategies. We'll examine official government statistics on gross domestic product, inflation, and unemployment, and then pivot to what this all means for the housing market, a critical sector for wealth generation and security for our target demographic. The aim is to equip you with the knowledge to navigate these uncertain times, to see beyond the headlines, and to make informed decisions. The narrative of an impending collapse is a strong one, and while we'll present evidence that supports this concern, we'll do so by sticking to the facts and figures from authoritative sources, allowing you to draw your own informed conclusions. Let's first look at Amazon.com. While it remains a colossal force, recent signals warrant a closer look, especially when we consider its role as an economic indicator. For a company that has long symbolized relentless expansion, any sign of deceleration or shifting investor sentiment can send ripples across the market. According to data from Yahoo Finance, Amazon's stock over the past year, while showing periods of growth, has also experienced volatility that reflects broader market uncertainties. For instance, looking at the daily stock chart data from the past year, we can observe significant fluctuations. While the stock might have hit highs, any downturns or periods of stagnation in a company of this magnitude are noteworthy. More telling, perhaps, are the insights into its operations and outlook. The latest stock insights from Yahoo Finance provide a mixed picture. While there might be positive long-term outlooks from some analysts, any downward revisions in earning estimates, concerns about specific segments like cloud computing growth rates, or increased operational costs can be interpreted as signs of pressure. For example, if we see a trend where revenue growth, while still positive, is not meeting the aggressive targets of previous years, or if profit margins are squeezed due to rising costs or competitive pressures, these are the subtle indicators that contribute to a narrative of a decline in its previous meteoric trajectory. It's not necessarily about an imminent collapse of Amazon itself, but rather what its changing fortunes might signify for consumer demand, business investment, and the overall health of the tech sector, which has been a major driver of economic growth. When a company that accounts for a significant portion of e-commerce and cloud infrastructure shows signs of hitting headwinds, it's a critical data point. We're talking about a company whose performance is intrinsically linked to consumer confidence and business activity. Therefore, any perceived decline or even a significant slowdown in its growth trajectory isn't just a corporate issue, it's a potential early warning for the broader economy. These are not just abstract numbers, they reflect real-world shifts in spending and investment that can have far-reaching consequences. Now, let's broaden our lens and look at the vital signs of the U.S. economy. The gross domestic product, or GDP, is the most comprehensive measure of our nation's economic health. According to the U.S. Bureau of Economic Analysis, BEA, real GDP showed an increase of 2.4% in the fourth quarter of 2024. However, the advance estimate for the first quarter of 2025 painted a different picture, with real GDP decreasing at an annual rate of 0.3%. This contraction, the first in 3 years as reported by sources like CBS News and Yahoo Finance, referenced referencing BEA data, is a significant development. While one quarter doesn't define a recession, a negative GDP figure, particularly following a period of growth, is a clear warning sign that the economic momentum is slowing or even reversing. For investors and potential home buyers, a shrinking economy can mean reduced consumer spending, lower corporate profits, and increased caution in investment and lending markets. This isn't just a statistic, it's an indicator of the overall economic environment in which your investments and property values exist. Then there's inflation. The Consumer Price Index, CPI, tracked by the U.S. Bureau of Labor Statistics, BLS, gives us a clear view of how the cost of living is changing. For the 12 months ending March 2025, the CPI for all urban consumers rose 2.4%. While this might seem moderate compared to some recent peaks, persistent inflation, even at lower levels, erodes purchasing power. For those on fixed incomes or planning for retirement, this is a critical concern. It means your savings may not stretch as far, and the real returns on your investments could be lower. The BLS also reported that the index for all items less food and energy, often called core inflation, increased 2.8% over the last 12 months as of March 2025. This underlying inflationary pressure can impact everything from daily expenses to the cost of building materials, which directly affects the housing market. When the cost of goods and services consistently rises, it puts a strain on household budgets and can dampen consumer sentiment, a key driver of economic growth. Compounding these concerns is the employment situation. The U.S. Bureau of Labor Statistics reported that the unemployment rate was 4.2% in April 2025. While this rate on its face might not seem alarming compared to historic highs, any uptick or stagnation in a period of economic uncertainty can be a cause for concern. For instance, the BLS news release from April 2025 indicated that while non-farm payroll employment increased, the unemployment rate remained unchanged. A static or rising unemployment rate, coupled with slowing GDP and persistent inflation, can signal a weakening labor market. This has direct implications for the housing market. Fewer jobs or stagnant wage growth means less purchasing power for potential home buyers and increased risk of mortgage defaults. For investors, a weaker labor market can translate to lower rental demand or downward pressure on rental prices in certain areas. It's a crucial piece of the economic puzzle that directly impacts the financial well-being of individuals and the stability of the housing sector. So, how do these macroeconomic indicators translate to the housing market, an area of prime concern for our audience of homeowners and investors? The data reveals a complex and, in some ways, precarious situation. Let's start with home prices. The median sales price of houses sold for the United States, as tracked by FRED, the Federal Reserve Economic Data, stood at $416,900 in the first quarter of 2025. This is slightly down from $419,300 in Q4 2024 and $426,800 in Q1 2024. While not a dramatic crash, this cooling off in median prices or even slight decline in some data sets after years of rapid appreciation is a significant trend. For instance, the National Association of REALTORS also provides extensive housing statistics. Their data often shows regional variations, but the national trend indicates a market that is certainly not experiencing the frenetic growth of the recent past. For potential buyers, this might seem like a window of opportunity, but for existing homeowners and investors, it could mean a slowdown in equity growth or even a potential dip in property values if the trend accelerates. Next, let's consider sales volume. Existing home sales, according to the National Association of REALTORS, fell to a seasonally adjusted annual rate of 4.02 million in March 2025. This represents a decrease both month over month and year over year. Earlier in the year, February 2025 saw a slight uptick to 4.26 million, as reported by NAR and Trading Economics. But the overall trend for 2024, as highlighted by sources like Fortune, showed existing home sales at their lowest level in nearly 3 decades. A decline in sales volume is a classic indicator of a cooling market. It suggests that fewer buyers are willing or able to enter the market, potentially due to affordability challenges, economic uncertainty, or higher borrowing costs. For investors, lower sales volume can mean longer holding periods if they plan to sell, and for the market overall, it signals reduced liquidity. Mortgage rates are a critical lever in the housing market. According to Freddie Mac's primary mortgage market survey, the 30-year fixed-rate mortgage has seen considerable fluctuation. As of early May 2025, rates were hovering around 6.76% to 6.81%, as reported by various outlets covering Freddie Mac data. While these rates have dipped slightly from earlier peaks in the past year, which were sometimes above 7%, they remain significantly higher than the ultra-low rates seen a few years ago. For example, Statista noted the 30-year fixed rate averaged 6.63% in Q4 2024, and that the average for 2023 was 6.81%. These elevated rates directly impact affordability. Higher mortgage rates mean higher monthly payments for home buyers, pushing many out of the market or forcing them to buy less expensive homes. For investors relying on leverage, higher borrowing costs can significantly impact cash flow and overall returns on rental properties. The National Mortgage Database, NMDB, from FHFA also provides comprehensive statistics on outstanding mortgages, which can offer deeper insights into the overall health and risk within the mortgage market. The current interest rate environment, combined with still high home prices in many areas, creates a challenging landscape for both prospective buyers and investors looking to expand their portfolios. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. What does this confluence of factors, a volatile tech bellwether like Amazon, a contracting GDP, persistent inflation, a somewhat stagnant unemployment picture, cooling home prices, falling sales volumes, and elevated mortgage rates truly signify for the U.S. economy, and specifically for you, the experienced homebuyer and investor? The narrative that emerges is one of increasing fragility. The robust growth we witnessed in previous years appears to be waning, replaced by a period of uncertainty and potential contraction. The decline in Amazon's growth trajectory, or even increased volatility, isn't just about one company. It reflects broader consumer sentiment and business investment trends. When consumers are worried about inflation and job security, discretionary spending, which fuels a significant part of Amazon's retail business, tends to decrease. Similarly, businesses might pull back on cloud investments if they anticipate an economic slowdown. The official GDP contraction in Q1 2025 is perhaps the most direct signal of an economic slowdown. This isn't an isolated statistic, it's the sum total of all goods and services produced, and a negative number indicates the economy is shrinking. For those of you who have navigated previous economic downturns, such as the 2008 financial crisis or the dot-com bust, you understand that these headline numbers often precede more tangible impacts on investments and asset values. The current inflationary environment, with the CPI at 2.4% annually as of March 2025, further complicates the picture. While not hyperinflation, it's a persistent erosion of purchasing power that affects everything from the cost of maintaining a home to the real returns on your investment portfolio. For investors, this means that even if your assets appreciate, the real gain might be diminished by inflation. It also puts pressure on the Federal Reserve to maintain higher interest rates, which, as we've seen, directly impacts mortgage affordability and the cost of capital for investments. The housing market data we've reviewed, the cooling median sales prices from FRED and NAR, the declining existing home sales volumes, and the persistently elevated mortgage rates reported by Freddie Mac all point towards a sector under pressure. For homeowners, this could mean a period of stagnant or declining home equity. For investors, particularly those who entered the market at its peak, this could mean lower than expected returns, challenges in finding tenants at desired rental rates if unemployment rises, or difficulty in exiting investments profitability. Consider specific locations. While a national overview is useful, certain regional markets that saw extreme price appreciation during the pandemic boom might be more vulnerable to corrections. Areas heavily reliant on a single industry, or those that experience significant population outflows as remote work trends shift, could face more pronounced downturns. Sophisticated investors are likely already recalibrating their strategies, perhaps shifting towards more defensive assets, increasing cash reserves, or looking for opportunities in distressed markets if a deeper correction occurs. The behavior of institutional investors, often a leading indicator, should also be monitored. A flight to safety or significant sell-off in real estate investment trusts, REITs, could signal broader concerns about the sector. The interconnectedness of these factors is crucial to understand. A slowdown in Amazon's growth can impact employment in the tech and logistics sectors. A contracting GDP reduces overall economic activity, affecting jobs and income across the board. Inflation erodes savings and purchasing power, while higher interest rates make borrowing more expensive, further dampening economic activity and hitting the housing market hard. It's not just a series of isolated data points. It's a web of economic forces that appear to be aligning in a way that suggests a significant economic downturn, if not a full-blown collapse, is a distinct possibility. The challenge for you as experienced individuals is to look at this evidence, consider your own financial situation and risk tolerance, and make proactive decisions rather than reactive ones. This might involve reevaluating your investment portfolio, stress testing your real estate holdings against potential declines in value or rental income, or perhaps delaying significant new investments until the economic picture becomes clearer. The key is to be informed, vigilant, and prepared for a range of potential outcomes. Consider the psychological impact on the market. When a titan like Amazon shows signs of slowing, it doesn't just affect its stock price, it influences investor sentiment across the board. For those of you who have built wealth over decades, you know that market psychology can be as powerful as underlying fundamentals, at least in the short to medium term. A perceived weakness in a market leader can trigger broader sell-offs or a flight to perceived safety, impacting everything from retirement accounts to the availability of investment capital. The narrative of an economic slowdown, amplified by concerning signals from major corporations and key economic indicators, can become a self-fulfilling prophecy if businesses and consumers alike pull back on spending and investment out of caution. This is where understanding the data becomes crucial to separate genuine risk from market noise. For male home buyers and investors over 45, this economic climate presents a unique set of challenges and potential, albeit risky, opportunities. Many in this demographic are either looking to secure their retirement, downsize, or make strategic investments to preserve and grow capital. A contracting economy with high interest rates and a cooling housing market demands a more cautious and analytical approach. For instance, if you're considering buying a home, the current environment might offer more negotiating power than in previous years, as sellers become more attuned to the shifting market. However, the higher mortgage rates mean that affordability remains a significant hurdle, even if prices soften. It's a delicate balance between potentially lower acquisition costs and higher financing costs. Careful financial planning, including securing pre-approvals and understanding the long-term implications of current interest rates, is more critical than ever. For property investors, the landscape is equally complex. The slowdown in home sales volume and the potential for stagnant or declining prices mean that strategies reliant on rapid appreciation may no longer be viable. Instead, focusing on properties with strong cash flow potential in resilient rental markets becomes paramount. This might involve looking at multifamily units, properties in areas with diverse employment bases, or even exploring niche markets. The increased cost of borrowing also means that highly leveraged investments carry greater risk. Investors might need to consider higher down payments or look for properties that offer a significant discount to current market value to ensure a viable return. Furthermore, the potential for a weaker labor market could impact tenant quality and vacancy rates, requiring more diligent property management and tenant screening. The days of easy profits in the real estate market appear to be numbered, replaced by a need for meticulous due diligence and a long-term perspective. Let's revisit the connection to Amazon. Its performance is not just about e-commerce. Its cloud division, Amazon Web Services, is a critical infrastructure for countless businesses. A slowdown in AWS growth, which has been a profit engine for Amazon, could indicate that businesses are cutting back on IT spending and innovation, another sign of economic caution. This has ripple effects throughout the tech sector and beyond. Moreover, Amazon's employment footprint is vast. Any significant layoffs or hiring freezes at Amazon or in the broader tech and logistics sectors it influences can directly impact local economies and housing markets, particularly in areas where these companies have a large presence. For example, cities like Seattle or areas around major Amazon fulfillment centers could experience localized economic headwinds if the company significantly scales back its operations or growth plans. These are not abstract economic theories. These are real-world impacts that can affect property values and investment returns in specific geographic locations. The broader economic indicators we've discussed, the GDP contraction, persistent inflation, and the unemployment rate, create an environment where risk management becomes the primary focus. For investors over 45, capital preservation is often as important, if not more so, than aggressive growth. This might mean rebalancing portfolios to reduce exposure to more volatile assets, increasing allocations to fixed income, though even that has its challenges in an inflationary environment, or holding more cash. It also means being wary of investments that promise outsized returns in an uncertain market, as these often come with correspondingly high risks. The old adage, if it sounds too good to be true, it probably is particularly relevant in times like these. What we're witnessing is a potential paradigm shift. The era of cheap money and seemingly endless growth is facing significant headwinds. The decline, or rather the recalibration of giants like Amazon, coupled with concerning macroeconomic data, suggests that the U.S. economy could be entering a period of stagflation, stagnant growth with inflation, or even a recession. While no one can predict the future with certainty, the evidence we've presented from authoritative sources like the BEA, BLS, FRED, and NAR points towards a period of heightened economic risk. The key for male home buyers and investors over 45 is not to panic, but to be prepared. This involves staying informed, critically evaluating investment opportunities, understanding your own risk tolerance, and making decisions based on data and a long-term strategy rather than short-term market sentiment. The coming months and years will likely require a more defensive and strategic approach to wealth management and real estate investments. The resilience and experience gained from navigating previous economic cycles will be invaluable in weathering this potential storm and identifying genuine opportunities that may arise from market dislocations. Thanks for watching. If you found this analysis helpful, please hit that like button, subscribe for more real estate market insights, and share your thoughts in the comments below. Please share this with a friend and watch this one as well.